Jerome Powell's annual Jackson Hole rampage just ended, his once-a-year speech, where he emerges from his den and if he sees his shadow, we get rate hikes for another year. This time around, Powell did see his shadow, promising higher rates for longer in a hawkish speech, lamenting that the Fed has been singularly unsuccessful at making you lose your job, so they will have to keep at it.
We are prepared to raise rates further if appropriate, and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. As is often the case, we are navigating by the stars under cloudy skies.
Jerome's speech waxed lyrical about, quote, navigating by these stars under cloudy skies, not a joke. But in short, he said he'll hold rates at a restrictive level and that he's prepared to keep hiking until he sees some, quote, softening in the labor market. In other words, until he's put millions more Americans out of work or at least cut their wages to an appropriate level for a plebe. Why so dark? Because Powell admitted that the progress on inflation so far has been one-offs. Supply chains going from jammed to empty, the world routing around Russia's war, and oil prices that always fall in recessions. Meanwhile, core inflation, the one that the Fed actually pays attention to, has been stuck above 4% for 32 months now. Because Jerome is unwilling to confront the actual cause of our inflation, which is out of control federal spending. So instead, he has to soften that labor market to earn his keep. Happily, Jerome did brush off calls to raise the Fed's inflation target to 3%, saying, quote, 2% is and will remain our target. So the New York Times and especially Paul Krugman have a lot more work to do selling that one. With Jerome's cloudy skies in the mix, financial markets are now predicting yet more hikes this year, at best followed by a very long pause, where the Fed doesn't even begin to cut until at least June of 2024, which is very handy for the upcoming election. That means those 7.5% mortgages and $2,600 monthly payments, now closer to $2,700, are here to stay. So what's next? So far, the economy has held up to a surprising degree thanks to pandemic-era excess savings and pent-up demand for housing and cars. Those are the two big-ticket items for most consumers, but now all three are petering out. I recently did a video on excess savings draining away, and now the other two are on the chopping block. Moreover, the clock is ticking. In recent videos, I've mentioned how interest rate hikes typically run on an 18-month lag, as in it takes time to work through the economy since companies and families still have old, cheap debt that they're running through. In fact, the Fed only got rates to a restrictive level literally 2 months ago. So it's still very early to even be seeing the kind of financial stresses we're already seeing. At this point, it does not look like the Fed's going to let up. That's what Powell is promising, meaning that clock is ticking away. Indeed, going by Powell's tone today, it sounds like, if anything, we may actually get more rate hikes, along with even more softening of those labor markets, the worst case being a replay of that 1970s nightmare of twin peak inflation, which is certainly playing on loop at the Fed's evil lair in Washington. In short, expect more pain from a floundering Fed. Okay, we'll be watching. See you next time.